how to bulletproof your financial plan even when life gets hard.
You know, when you go through these big life milestones and changes, your finances are not immune. And I'm going through one right now. I recently had a baby, which is awesome, by the way. But now that the dust is kind of settling, we're getting used to having the baby in the house and all that stuff. Like, our mind is turning to, okay, where are we financially? What do we have to go back and shore up? All of those things. And so I made this list of things that I need to get taken care of. And I thought, actually, this is fantastic for any life change, whether it's like a marriage, a divorce, or having a baby. This is all stuff that is really important, and you don't want to be caught with it not being put in place when you really need it. It's stuff that, like, you don't always think about, but I'm excited to kind of enter this new phase in my life and, like, get these taken care of.
Yeah, I'm excited about this because the one certainty that exists in this life is that things are changing, right? We're always going through constant life change. And what I think is so interesting, you know, I've been working with families and individuals for long enough. A lot of these things, you know, you're kind of talking about on the beginning of this journey, right? Having a baby and getting married and buying a house and doing all these things. It's amazing how much of this translates even into other changes that go throughout throughout your life. And I thought it was wonderful how you kind of laid out sort of, hey, here are the things that me and John are talking about. And I thought we should just kind of go through them.
Yep, let's do it. So these are
from the top and go
my
through
5 things that I'm working on right now. And I'm excited to hear your advice for myself and also for you listening as you're, you know, going to take care of these things in your own life. So the first one is the last will and testament.
Yeah, I think from a financial planning standpoint, this is an area that I see people screw up all the time, whether it's folks that are mature in their financial journey or even just very early starting on. So what are the conversations you and John have been having? Like, why is this number 1 on your list?
Because we don't have one.
Because you don't.
It's very easy to forget about, to be honest, especially when you are either single or just newly married and, like, you know, you haven't been investing for that long, so it doesn't feel that imperative. But now we have this little dependent who, like, relies on our income. And if anything were to happen to us, we'd rather have it laid out, right? And that's just the smart thing to do. So I'm looking into doing that.
Yeah, I think it's really interesting. A lot of folks ask us the question, even when they're early on, like, I just got out of college, I just graduated, I'm single. Do I need to have an estate plan? Do I need to go have a will? Do I need to have documents drawn up? And what I tell folks is, when your life is fairly simple, right? Perhaps you are just starting out and maybe you opened that first Roth IRA, or maybe you just started contributing to 401k, you probably don't need to go see an estate attorney. What I call the back of the napkin estate plan is probably okay. You have your beneficiaries filled out and that sort of thing. But once things do start to change and your life gets a little more complicated, you start having babies, you start acquiring debt, you start acquiring debt with another human being. Those are the kind of things you want to begin to have documents drawn up that if you're not here to make decisions, you want to be able to make those decisions instead of leaving it for other people. Now, this happens all the time, and I'll be curious in your experience if this has been something y'all have gone through. I'll ask someone, hey, well, something happens to you, you know, both of you guys. What do you want to have happen to Ike? And people say, oh, I don't know, because maybe it's my family and maybe it's his family. And, you know, it's kind of this, like, it's a hard thing to decide about, you know, what do I want to take place if I'm not here? If you think that that's a difficult conversation for you to have now, if that's a hard thing for you to figure out in this moment, imagine how much more difficult it is if you're not here to speak for yourself, if you're not here to weigh in.
That would just add another difficult layer to an already difficult situation for all of your loved ones, right? So so we've started having all of those conversations. So we just need to probably go to an estate attorney and get this done. Yeah,
and I don't think, you know, again, even for simple plans, even if you want to graduate from what I call back of the napkin, there are electronic solutions, right? Like, there are low-cost electronic providers where you can do that. I do think if there's anything that might be contentious, like grandparents, for example, sometimes grandparents are not in agreement about what they think is best for that grandchild. So if you do have something unique like that, having an attorney draft those documents probably does make a lot of sense as it relates to the kids. Yeah. One thing that I'm amazed of, and this is something I think people ought to, like, think about, is it's not just when you have a new baby either. A lot of times, maybe you've had multiple kids, and so your document wasn't written to account for that. Or perhaps when you had your documents done, your kids were babies. Well, now your kids are pre-adults, and so you're less concerned about like guardianship, and you're more concerned about, okay, well, how soon do I want
Right.
these people to be able to access this? Or maybe you've moved to a different state, or maybe your financial circumstances have changed. I would argue anytime you have a big life change, whether it's new babies, marriages, divorces. Oh, we see this all the time. Someone will get divorced and they won't go back and update the estate documents. Well, obviously some things have changed that you probably want to adjust
Right.
what's going to happen to your stuff and how that's going to play out. So anytime you have a really big life change, I always think it's a good idea. Just go review it. Reviewing it does not necessarily mean that you need to change it, but reviewing it does mean that you don't just put it in the file cabinet and forget about it forever.
Yeah, so that's a big one. Number one is that last will and testament. Number two, second thing I'm looking at is life insurance. Bo, full disclosure, I don't have life insurance either.
Okay,
I'm shopping
love
for
it.
it right
I
now.
love it.
What do I need to look for? What should I be thinking about?
Yeah, life insurance, again, it's one of those things none of us, especially early on, like you just had this like brand new baby, none of us want to think about, oh, well, what happens if I kick the bucket?
Sure.
What if I'm hit by that proverbial bus on a Tuesday? But whenever someone is depending on you, like whenever there are other human beings depending on your ability to generate income, there's an insurable need on your life. Well, there are really two types of insurance that you can buy. There is permanent insurance that's there forever, and there's term insurance that you can go out and buy and you pay for it for a certain term, and then it either goes away or you stop paying for it and it goes away. So people ask all the time, well, the permanent thing sounds better. Like if I'm 25,
It'll
what
just
if
always be there,
yeah,
right?
it'll
Yeah.
always be there. I'll always have it. It'll always be a solution. I think a lot of people are surprised to find out, especially folks who aren't maybe as familiar, as well versed in the financial world, that the difference in term life insurance and permanent life insurance is the cost. If you're looking for just bang for the buck to protect you, to protect your husband, to protect your children, term insurance is likely going to do that. And we actually put together a little illustration walking through the difference in costs at different ages. Now, this one was for a male in excellent
Yes.
health, right?
Yes. $1 million policy.
Good news for you, Ruby. Ladies, because the mortality tables and rates, your numbers are
It's gonna
actually
be even less.
It's going to be even less. It's going to be much less expensive. You know, if you look at someone who wanted to have $1 million of coverage at 25 years old, to buy term life insurance would cost a healthy male about $31 a month. To have that same level of coverage and permanent insurance is almost $700 a month.
That's remarkable to me.
It's unbelievable.
Like, that's a totally different decision. Like, at least for like looking at our financial situation and what we're trying to do and how much we're trying to save and all that stuff. It's like, first of all, the 20-year term kind of looks like a no-brainer now at this point in
Yep.
my life. And then, but the whole life would be just like a big decision. So
Be a
it's,
big
I
decision.
love that this is an option.
And I think what's great, there are wonderful resources out there where you can go get life insurance quotes. I think we pulled some of these from Xander Insurance. It's really easy to go out there and just put in your age, date of birth, what state you live in, how much you need, and you can see how much it costs. And we just showed 20-year term, but you can actually get term insurance in a number of varieties. You can get 10-year, 20-year, 30-year, and it's okay as you move throughout your life if you stack policies. So right now, you'll probably go get your very first policy, but I bet you 10 years in the future, your financial circumstances will have changed and
Sure.
your life circumstances will change. It's okay to go bolt that on. And so you can kind of build a ladder to make sure you're covering your insurance needs.
20-year was our example. Is that like a good ballpark to start?
I think so. That's what most people that we see. I mean, you could look at 30-year. The problem with doing 30-year right now is that we're at relatively young ages. Odds are we're going to be around in 30 years. One thing that we see happen a lot is folks who are kind of cresting on that 40-ish age range. 30-year policies tend to make a lot of sense there because the rates have not changed so much that it's super, super expensive, but it really does cover a big portion of the remaining insurable need in
Yeah.
your life.
That makes a lot of sense. So I'm shopping for life insurance. That's another one that I definitely want to shore up. Number 3 is that I need to clean up some accounts.
Okay.
Bo.
What do you mean by that?
The first one was, I went in to update some beneficiaries on one of my accounts recently, and I realized, oh, there's another person now. And oh, there's this secondary beneficiary. And then also I was just making sure that my husband was beneficiary on all my
Yep.
accounts too, because that's
Makes
really
sense.
important. Like if something happened to me, I would want to make sure that was seamless and set up. So I'm thinking through that too. Like, I want to make sure that that's all in place.
I think a lot of people forget that, right? Like, hey, I've got these accounts, 401ks, Roth IRAs, whatever. And yeah, I put beneficiaries back in the day, but now I've had kids, or maybe I was in a marriage that I'm no longer in, or maybe now I have multiple kids. Imagine how that conversation goes where you forgot to add the second sibling as the beneficiary
right.
to the policy. It gets kind of hairy, it gets kind of messy. So making sure that you're reviewing those, again, any big life change, those things that make you think, okay, I need to go look at my will again, you should also go do a beneficiary review. We have a practice here at the firm for our clients. We like to just check it every 3 or 4 years just to make sure that what they had in place 3 or 4 years ago is still what they want to be in place today.
Yeah. Another way that I'm working on cleaning up my accounts is just rolling over some old accounts. Like
Okay,
we've
yeah.
got some old retirement accounts just from previous employers. They're just kind of sitting out there, and it's easy to like just kind of forget what's in them. And so we're going to kind of work on getting that all into one place, which I'm really looking forward to. And I think that's going to really help with number 4 on my list, which is doing our annual net worth statement. You know, I really just started doing this because of you and Brian and the Money Guy show.
I love it.
And that's been really good. But, you know, I only have like a couple years of this under my belt. And so I'm kind of bringing my husband into that conversation too. And it is going to be really nice just to see how is all of this working together? And okay, we're trying to save this much and we're trying to do this. And it's actually kind of showing me how much I actually have. Like I said, like sometimes you forget about those old accounts and you forget like how much equity you have in your house or all of these different things. And so it is something that I'm finding really valuable.
With you and John, are one of you more financially minded than the other? Like one of you just tends to be the financial person and one of you not
I've shared
so much?
before, I think we're a little unique that we've kind of swapped roles a couple times.
Okay.
Like he was at first, and then when I started working here, of course, I came home with all these ideas. And now it has kind of shifted back to him just because I was like, I'm having this baby, you can do this.
Do you find that because those roles shift, when you guys do your net worth statement, does it allow you to have some like interesting conversations? Like, is it something that helps kind of, because we get so busy. And by the way, you have like this new baby at the house. So I imagine when you leave here, the last thing on your mind is probably finances. It's probably like feeding the baby and naps and diapers and spit up and all these things that come with a new baby. It's nice to have this centralized event that you guys can work together to have conversations around. Has that been something that's been helpful for y'all?
Yeah, and like I said, we've just recently, like in the last couple of years, started to do this. And I guess I did spearhead this. Like I'm the one who has filled this out. But yeah, just recently since even having the baby, it's kind of like, hey, we both need to look at this. And it's been really good.
You know, me and Brian talk about all the time. It's almost like Christmas morning at the end of the year. When we get to do our annual net worth statement. And we love the process so much that we actually built a tool that we make available for you guys. You can go over to learn.moneyguy.com and you can actually buy this net worth template. And what it does is it allows every year you to track your net worth. What are all the things that I own and what are all the things that I owe? And what's my net worth? And we put some really cool stuff on there like deferred taxes and interesting things to think about. But I think the real key and how my wife and I use this for a valuable like vision casting tool is what we call the dashboard, because it allows you to see front and center, hey, where are we going on this journey that we're on? Are we even moving in the right direction? You know, she's not listening right now, I don't think. Jenna she likes spending money more than I do. Not that she spends crazily, she just gets more utility. So I'm like, hey, we need to save. Hey, we need to invest. We need to do this. It's wonderful when we can do this where I can show her the fruits of our labor. Look at what's happening. Look at where we're going. Now, if you're a young person out there, right?
I've only got 2 years in mind. I'm using this tool and I love it, but I will say I am really excited to add more to it over the next few years and even see how this tool itself evolves and start to actually see this dashboard like really pay off. Because it's cool right now, even with 2 years, but man, I can't wait till mine looks like this, you know?
What I think is beautiful is if you look at this one, right? When it started, now this is a hypothetical, this is an actual net worth statement. It was negative. The net worth was negative. I hear people all the time say, oh, I just graduated. I got student loan debts. I don't have any assets. I've got a negative net worth. That's great.
It's okay.
Start tracking it. Go do this because your future self will thank you. I started doing my net worth a long time ago, and it is so fun to see the journey. And it's also kind of neat to like reminisce what you and I were talking about in your first few years of your working career. I was going through the same stuff. I was facing the same sort of things, and I can actually see that on my net worth statement. So if you're not someone out there doing an annual net worth statement, I would highly encourage you. Go check out learn.moneyguy.com and start doing that.
Yeah, it's an awesome tool. And then last but not least, my husband and I are talking for the first time about knowing our number. And when I say your number, I mean your retirement number. Like, what is your financial independence number? What does your goal actually look like? And I will say it's both sobering and motivating. Like, it's definitely giving me more of a why. Like, I know I should invest. I know that 25%,
Yep.
okay, Roth IRA, employer match. Like, I have some of these steps in place now, but now this is really just in the past few months, the first time that my husband and I have been like, what's our goal? And we're still kind of figuring it out, but that is a really interesting and important conversation to have.
I feel like we get asked that question all the time. Hey, what is the goal, right? Like, what are we ultimately going for? I think early on in your financial journey, your savings rate is the most important thing. That's
Sure.
what you should be focusing on. How can I get to 25%? If I'm at 0, how do I get to 5%? And how can I turn 5 into 10 and 10 into, and how do I get to 25%? But once you kind of get there and you've been a consistent saver for a number of years, you start kind of scratching your head. It's like, okay, I know this thing is working. I know that I'm doing what I'm supposed to be doing, but for what? Like,
Right.
what's the goal? What's the end game? We as a content team, we're actually working on something that Ruby's not going to let me talk about, but we are working on something that will help hopefully solve that problem about knowing what is your number. How do I know what that number is? Well, when you can begin to define it, when you can begin to understand what that is, the motivation is amazing. Again, this is something I show my wife. And Brian has talked about with his wife. He said, look, if we can just save in our 20s and our 30s, then we can take our foot off the pedal in their 40s. I've done the same thing with my wife. I said, look, if we can just save, build the foundation, it's going to be amazing. Now, she always comes back and she says, oh, I look so forward to being such a wealthy 90-year-old. Well, that's obviously not what's going to happen. You have to figure out how to balance those. But it is true. The more work you do early on, the more it will pay off. And knowing your number, knowing that thing that you're working towards will help you stay consistent and help you stay focused on the goals that you're trying to drive towards.
And I mean, you and Brian are living proof of that. I mean, Brian, especially right now, like, he really did say the same thing to Jennifer that you were saying, like, let's save. And like, he's getting to see the fruits way before he's 90.
Absolutely.
You know, like, he just got to take his daughter on her senior trip and make some really awesome memories. Like he's worked for it. And I think that's amazing.
What I think is so great is we even have some comments come in right now. It's like, hey, I don't know what my number is. My number changes. It moves.
Right.
That's okay. It's kind of supposed to. What your number is when you are 25 years old will probably be one thing, but what it is by the time you get to 35 to 40 probably is something different too, because that's the way that life works. Our circumstances change. But if you can at least see that horizon or have an idea of what that horizon looks like, that's going to be the thing that gives you the staying power to actually work towards that big, the great big, beautiful tomorrow. I had to say his thing.
Yes. And so we're working on some more content to help you with that. And like I said, this is a conversation that John and I are having. Like, I don't fully know, like, this exact number is my number. That's what I'm working on. And like you said, is going to evolve. And it's a really good conversation to have.
Maybe you are someone, though, I think this is important to mention. Maybe you are further along in your journey. Like, hey, I'm no longer at the I kind of need to figure out, like, I need to know my number because I am thinking about leaving the workforce or changing careers or stepping into financial independence or whatever that thing is. If you are someone who's finding yourself at that place, and you're like, okay, I've done great saving. I know how I've gotten here, but I'm not exactly sure what the next steps look like or how to work through that transition. That's a great time to think about potentially taking the relationship to the next level. You likely only get one retirement or maybe 2 or 3 retirements if you're a career changer. Our team here at Abound Wealth, we've done hundreds of retirements. So we've actually seasoned ourselves in helping people work through that transition. So if you're someone looking for guidance, trying to figure out what that might look like, go to aboundwealth.com, check us out, hit the work with us. We'd love to start a conversation with you.
I love it. So many good resources. So yeah, that's what I'm working on, getting my finances shored up, and I'm excited to go on that journey. And I hope that that kind of inspires you to go back and make sure your stuff's in order too, because it's important.
I love it.
Want to do some questions, Bo?
I would love to. I got to get my I heard somebody said the other day they're surprised they didn't know I'd take notes. If I don't take notes, I'll forget what you said. I'll forget all the context of the question. So that's the reason.
Yeah, I know, because sometimes people give us a lot of detail, which is great, but you got to remember as you answer. All right, we're gonna start with Robbie.
Okay.
He's got a question for you. Once you reach level 7 or 8 of the financial order of operations, do you need to get into real estate? Because that's about the time that we say, hey, now would be a good time to do an investment property or, things of that nature. But do you have to do that? And can you use REITs instead or simply skip real estate exposure altogether? What do you think?
Great. Okay. First, can you hand me Brian's little thing right there?
Of course.
That we did? So she said the financial order of operations. For those of you who don't know, we've sort of distilled into 9 steps, 9 tried and true steps about how you should think about saving for your next dollar. And so what Robbie's question is, he said, hey, I'm thinking about real estate, and I've heard you guys say that happens around step 7, which is hyperaccumulation, or step 8, which is prepaid future expenses. Do I have to do it? Do I have to start doing real estate? Well, one of the first things that I always remind people of is I ask them, hey, do you own a home? And for a lot of folks, when they say, yeah, I own a home, I say, great, you already have real estate exposure. You may not realize that you had real estate exposure, but just through the place that you live, whether it's a condo, house, whatever, if you own it, you have equity in it, then you already have some real estate exposure. So it's naive to think that you don't have any real estate exposure. Now, if you're someone who's renting or you don't own a place, then that's a different story. But for the majority of folks who are kind of building through their wealth journey, that's something that happens along the line. So then his question is, okay, well, if I'm not that person, do I have to have real estate? I don't think so. We've talked all the time. A lot of people love the brochure when it comes to rental estate, whether it's like commercial real estate or residential rental real estate. And it's this idea of passive income. I'm going to go borrow some money. I'm going to buy a property and put a tenant in there. And I'm just going to start collecting rent checks. That's great if it actually works out that way. Let me tell you firsthand, as a commercial property owner, when the roof starts leaking, it does not feel very passive.
Mm-hmm.
When tenants have plumbing issues, it does not feel very passive. And a lot of folks say, I just don't want to deal with that. I don't want to have the headache. I don't want to be a landlord. I don't want the liability.
And he knows. I've seen him plunge a toilet.
I have plunged toilets here. And it's
just saying.
It's not a passive activity. So I don't think that real estate is for everyone. Now, are there great benefits to it? Yeah, for sure. There's tax benefits that are there. There's growth benefits. There's income benefits. But the beautiful thing about building wealth, specifically in this country, is there's no one path to wealth. We have plenty of clients who have never invested in commercial property or residential real estate or any of that sort of thing, and they've still been able to build up a portfolio that provides financial independence without doing that. We have others who have been able to take advantage of real estate. So I would never make a financial decision just because, oh, well, I'm supposed to do that. I have to invest in that thing. That's not the case at all. And you mentioned, maybe you listened to our show and you've heard us say, oh, well, real estate is a great hedge against inflation and it's a really good thing to own over the long term. There's income potential. There are really, really easy ways to get access to real estate. He mentioned one in his question, using REITs. Publicly traded real estate investment trusts are a great thing. There's tons of index funds out there that will allow you to have real estate exposure. Just because we say that you can do it at step 7 or 8, just like when we say you can prepay your mortgage if you're young and don't love math, it's okay to not do real estate. It's not a one size fits all. It's not a must. But if you do want to do it, we think it makes sense to do that after you've established a steady foundation, because when you do real estate, you got to make sure that you're deep.
Right.
Because if things go bad, whether it's commercial, whether it's residential, you need to make sure you have a financial foundation in place where investing in real estate doesn't bury you.
Yeah, and Robbie did follow up on this question. He did say, he doesn't have a desire to be a landlord.
Yeah, right.
And so that might be a big part of your answer, and that's totally okay. There's a lot of other investment strategies like Bo was talking about that can get you to your goals too.
Yep.
So yeah, thanks so much for your question, Robbie. All right, we got a question from Weather Dude.
Oh, okay.
These usernames are always so fun to me. Okay.
Do you think he's actually a weather guy?
I don't know. I was wondering that too.
Weather meteorologist. Are they weathermen? What's the appropriate nomenclature? Yeah. Meteorologist.
Yes, very official.
Are all weathermen meteorologists?
I think so.
Nate, you look like you would know the answer. Okay, yeah. All right, cool. Got it.
Okay, well, Weather Dude asks, should I stop investing in my 401k with losses and invest in I-bonds, treasuries, or CDs instead?
Oh, man. Okay, so here's what's happened, right? Mm-hmm. As of the recording of this show, markets have not been incredibly kind, right? This year, to the beginning of 2022, has not been wonderful from investors when they look at their account statements. You look and you're like, oh, my account's down 10, 15, 20, 25%. And it's kind of painful, right? I put money in last month and it's worth less than it is this month. And the money I put in 2 months ago is worth even less. So a lot of people are asking the question, all right, man, I feel like I'm just throwing money in a hole. Should I pause this, right? whenever, and by the way, this is not, weather dude, you're in good company because we have a bunch of clients, like fantastically successful folks who ask this exact same question. And not to like be too tongue in cheek, but I always ask this question. Okay, well, when it comes to investing, do you like to buy low or buy high? And most everyone answers that question. Well, I like to buy low. I want to buy low and sell high. What you have to recognize is that when volatility is taking place, when the market is giving you a gigantic sale, it should not be something that causes you to run for the exits. It should be something that causes you to start salivating. You should start getting excited about the opportunities that are present, especially if you're someone who's young and has a lot of time for these markets to recover. I can assure you, if you have a 10-year, 15-year, 20-year time horizon, you likely won't really care what the market did in the first 6-7 months of 2022 because it will be kind of negligent. What you will care about is, was I putting my soldiers into my army of dollar bills at that time? Because some of those dollars that you can put into the market during a recession or during a downturn or during a bear market will be some of the hardest workers that you have. So I say all that, weather dude. If you still do need to work through the financial order of operations, you can go to moneyguide.com/resources and download your free non-laminated copy.
You could laminate it though.
You can laminate it. You have to make sure you're working through the order the correct way. Have you covered your deductibles? Are you getting the employer match? Do you have your emergency reserves in place? If you don't have those things, then yeah, maybe you do need to shore up some cash. But assuming you've satisfied all of those and now you're on to step 5, step 6, step 7, I think, especially if you're someone who's young, not even young, if you're someone who's in the accumulation phase, you could be someone in their 50s or 60s, but if you're not retiring and you're still saving and you're still growing, you should be getting excited about the opportunities present right now because everything is on sale right now. If you really loved stock X in January, you should love it even more right now because it's 15-20% cheaper than it was. So I am not of the opinion, assuming that you've satisfied all that you should stop contributing into the equity markets. If you're dollar cost averaging, which all of us are doing that through our 401ks, through our retirement plans, dollar cost averaging has its greatest benefit during market downturns or periods of volatility. It's when you want to be doing it. So I would not recommend going to cash, going to I-bonds, doing those sort of things. I would keep those 401k dollars rocking and rolling.
Yeah, you don't want fear to be the driver of those decisions. It's like, what does the math and your retirement goals actually look like? You know, we've done a lot of examples on various shows about investing that just kind of show the power of your dollars over time, the power of compounding interest, even through these downturns. So definitely go back, in some of the older shows and see what you can find and see if it kind of sparks some of these ideas too. All right. Punit has a question. He says, baby is on the way. Congrats.
Hey, congrats.
Is it smart to max out our HSA knowing those expenses are coming up while pausing other forms of investment? He says they do have a company match that's up to $1,000 and plus it reduces taxable income. So how should he think about this? Like, how important is the HSA versus his investments, like his 401k, Roth, all that stuff?
I mean, it's so funny. Normally I get to sit here and listen to Brian repeat himself over and over. But here's where I've got to start, Punit. The first thing I got to say is you got to go by the financial order of operations as your first line of defense. So the very number 2 thing on here is employer match, right? It's free money. If you have it inside of your power to be able to go and capture free money, you're not going to beat that rate of return anywhere. You're not going to, the tax-free opportunities available through HSAs is not going to max just your employer giving you free money. So I think you have to think through that first. Okay, I got to go get my employer match. Do I have any high interest debt? I need to be knocking that out. Do I have an emergency fund in place? Okay, great. Now I'm building. I got this baby coming, which is awesome, by the way. Congratulations. Your life is going to be super sweet now because it's having a baby, as Reby can attest, is just an awesome thing. Be like, man, okay, I think I might need these funds. Should I put them in HSA? Well, one of the beautiful benefits of an HSA is that those dollars can be invested and they can grow. And if you use them for qualified medical expenses, they can be tax-free. But all of that is if you invest it. We know that 96% of folks don't invest their HSA dollars. They just use it as an intra-year slush fund. It's kind of a conduit account. We'll talk about that in a second. 4% of folks take advantage of the triple tax advantage. They put the money in, they invest it, they let it grow, and then they use those earnings to either reimburse themselves or they use them to pay for medical expenses. What you're saying, though, is I have medical costs coming up. So for the case of this example, I'm going to assume you need those dollars to be able to pay those medical costs. Well, here's a beautiful thing that HSAs provide that other tax-free vehicles like a Roth IRA don't provide. You get a tax deduction on the front end. When you put money into a health savings account, you get to take a tax deduction this year. So the money goes in and it kind of goes in like pre-tax dollars, but then it can grow like tax-free dollars. It's literally the best of both worlds when it comes to traditional type assets and Roth type assets. When we had our first baby, it was one of those things, I had money going in different places and things were tight-ish, right? And I'm like, oh my gosh, and we had to buy a house and all these other things that were taking place. When we got our bill, I was like, okay, I need to pay this. I literally made a contribution for whatever the bill was into my health savings account, and then like the next day distributed it back out and went and paid the bill. Just by doing that little round trip transaction, I was able to save money on taxes. Mm-hmm. So I think in your situation, does it make sense to put money in the HSA, even if you need to use it today? Assuming your emergency fund and all that stuff is in place, I would say absolutely yes, because in my opinion, health savings accounts are one of the most attractive financial vehicles that exist because they are triple and sometimes quadruple tax advantaged.
Yeah, really good answer. And just, I would not stop your 401k if you can. I know you started with that, but I kind of wanted to drive that home too. You don't want to miss out on that free money. So I would say it's a little bit of a both and if you can do that.
Love it.
All right. Jennifer has a question. She says, for term life insurance, we were just talking about life insurance. Should a family plan for income growth over the next 15 to 20 years when picking life insurance? When you may need life insurance, when you may need it, the life insurance might need to be higher. Mm-hmm. Is that true? So how should she think about that?
Well, let me ask you a question, Rabe. So you said that it sounds like you and Jennifer are in a similar situation.
It's true.
You and your husband have had that conversation.
I'm shopping right now. Mm-hmm.
Have y'all had that conversation about like how much do we buy, or what if we need more in the future? Have y'all gone down that route?
Not totally, okay. Because that's kind of what I'm trying to figure out, right? Like I know that I want a term policy. So yeah, I'm kind of with Jennifer on this one.
So
what should I be thinking about?
Yeah, let me speak to that. Here's in my opinion, when you buy life insurance, what you want to protect against is what happens if I get hit by the bus tomorrow, right? That's the thing that you're thinking about. And so how much do I need if I were not here tomorrow to be able to protect the people that are counting on me and depending on me? Well, a really easy rule of thumb is 10 times your annual income. Plus if you have outstanding debts you want to pay for, maybe you got to think about college, 10 times your annual income usually gets you in the ballpark. Now, there's a more sophisticated way to think about this. You can think about, and this is kind of how we do our insurance analysis here, the present value of future earnings plus future obligations like college, retirement, debt payoff, those sorts of things. And there's a present value calculation you can do there to determine insurable need. Most folks don't need to go through that calculation, especially not like early on in your career. 10 times it gets you pretty close, right? It gets you kind of in the ballpark. Well, you might be sitting in Jennifer's situation or even in the situation you're in and think, okay, well, 10 times my income right now might not be the same as 10 times my income 10 years from now. That's okay. That's the beautiful part about term insurance. We know that like for a 25-year-old healthy male, for $1 million of coverage, it's like $30 a month. Mm-hmm. It is like incredibly inexpensive.
Yeah.
So, okay, say that you want to go get $1 million at age 25. Perfect. Well, say that you continue to work and maybe have some more kids and you get a bigger mortgage and your income goes up and just lifestyle increases because that's what naturally happens to all of us. At age 35, 10 years in the future, you decide, okay, I need more insurance. Well, great. You go start shopping for it. At that point in time, say, okay, what's 10 times my income? I've already got $1 million in coverage. And that $1 million 20-year policy I bought at 25 still has 10 more years on it. How much longer do I need insurance? Do I need to get another 20-year policy and add an extra million so I have $2 million of coverage? Or do I want to let that $1 million fall off and I'll just get a 20-year, $2 million policy? Or maybe do I want to look at a $3 million policy? And it's not uncommon. I know this has happened in my own personal situation. I have the very first insurance policy that I ever took out. And since then I've added 2 or 3 on top of it. And I just kind of have like this staggered thing of term life insurance going throughout that'll carry me, well into the future, well into my children's adulthood, because that's what I'm really trying to protect. If I can just get my kids to adulthood, the plan is my wife and I, with what we've been saving and trying to accumulate, that she'll be okay if, at that point, once the kids are of adult age, and you can just kind of bolt them on as you go. The other beautiful thing about term, you're not married to it. You're not committed to it. You may get term insurance now and pay for it for, the next 6 years, and then you hit the mega millions and you're like, I don't need term insurance. Great. You can just drop it. Just stop paying for it. It goes away. No harm, no foul. So for Jennifer, it's okay, I think, if you think about income growth over the next 2 or 3 years, but I wouldn't try to get insurance at 25 for your 40-year-old self.
Sure.
I just think that's going to be hard.
Bolt it on.
You can always bolt it on. And if you ever watch like TV commercials, do people watch TV commercials anymore? AJ, do you watch TV commercials? No, you don't see TV commercials.
I mean, YouTube
So
commercials.
YouTube ad, when you used to see commercials for life insurance, they always show like a sample policy, and it's always a 40-year-old. If you always look, it's always a 40. Because at age 40 is really where term insurance is still like super, super cheap. Once you start getting older, mortality starts kind of working against you. But right there in your 40s, it's really, really inexpensive. So if you get policies in your early 20s, mid 20s, late 20s, early 30s, mid 30s, late 30s, even early 40s, it's very, very, very affordable. So bolting it on is not an incredibly difficult thing to do, assuming you got to stay healthy. They do make you pass a health exam, but it's not an incredibly difficult thing to do.
Yeah. So hopefully that gives you some more food for thought, Jennifer. I know that is helpful for me. And I think I knew in the back of my head that you guys had shared you can always add more later if you're getting term, which is super comforting and takes some of the pressure off, right? Okay. I got a question from Joseph. It's kind of a fun one.
Okay.
He says, let's say, hypothetically, I'm the lucky one and win the Mega Millions tonight.
Oh.
Okay. Say he's got a big windfall of money. What should be my first steps after getting that money? And then secondly, how can the Money Guy Show and Abound Wealth, our financial planning firm, help him with that?
Love
Thanks.
it.
Isn't that a fun question?
That is a fun question. Me and Brian actually did a show. This is a number of years ago. This is pre-Reby. This is pre-Nashville, pre-move. This is back when we're in Georgia. About what to do if you win the jackpot. At the time, it was the largest jackpot ever. I want to say it was like $600, $700 million back then. And we actually did a show kind of walking through, all right, here are the steps. Boom, 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 boom. It's a pretty easy answer, Joe. So the very first step is you want to go to boundwealth.com. You want to reach out and talk with one of our advisors. It is true, though.
This is the kind of stuff that they could really help with in all seriousness.
But let's say that, okay, I'll give you a thing. If you live in a state where you can claim it anonymously, it's probably a smart idea to claim it anonymously because, when you come into this kind of wealth and everybody knows about it, people start coming out of the woodwork. Make sure you have a good accountant, good attorney, good financial advisor. Get that team of 3 and then come up with a plan on how to go get it. So that's the lottery question. But maybe you're someone who's not come into the Mega Millions, but maybe you're someone who retired and you just took the lump sum pension benefit. And so while it's not hundreds of millions of dollars, maybe it's still a 7-figure check that just showed up and you're like, holy cow, what do I do? I've never had this kind of money. Maybe you came into an inheritance. Maybe you sold a piece of land. Maybe you sold a business. Anytime a windfall comes your way, there are some ways to think about it to figure out, okay, what should I do? Here's the first step. Don't get in a hurry. So often we see people start to get in a frenzy and money comes their way and they immediately decide, I got to go do something right now. I got to go do something right now. Most times, in most circumstances, you don't have to do anything immediately. You want to have enough time to put together a plan in place. And generally speaking, we see people come into big windfalls when they sell stuff and they go buy something really expensive. Like, okay, I just bought my big multi-million-dollar house. Well, then I bought the fancy car. Well, but then I needed the truck to pull the boat and then the jet ski. And then I had to get what's amazing
Before you
is
know it.
we all get on this treadmill where all the excitement and the newness of things just kind of goes away. So you have to be really careful when you come into wealth and when you have new wealth that you don't ruin the excitement, the physiological change that happens in your brain when you make big decisions. We see a lot of people screw this up a lot. So we say, hey, think about the big decisions you want to make. And let's put together a timeline through which we want to do that. Okay, I have a desire to buy a bigger house. Okay, great. Let's talk about that. I have a desire to buy a lake house. Okay, let's talk about that. I have a desire to buy a boat. Okay, let's talk about that. And let's figure out what all those things look like, what the carry cost of those are. And realistically, if you go out and buy 5 brand new cars, how much can you drive? You can't drive more than 1 car at a time. So let's think through, realistically, what's your why? What's your goal? What's the thing you're working for? 20 years from now, when you look back, what will you want to have seen happen with these dollars that came into your way? For most people, the answer is, hey, I want to be able to retire. I want to be financially independent. I want my money to work harder than I worked. And I don't want to have to freak out. I want to live the life I want to live on my terms. I want to do what I want to do, when I want to do it, the way I want to do it. Well, that's exactly what we do when we help people plan for financial independence and plan for retirement. And we actually put in a plan and we stress test all these variables. Okay, what if we do buy that lake house? What if we do buy that beach house? What if we do fill in the blank? Now, here is one thing that is a little bit unique that I think, I don't know that this is our unique take, but anytime someone comes into big money, big inheritance, big asset sale, and there's a lot of cash flow. And I'm talking about like big sums. We say, all right, let's come up with your blow amount. Mm-hmm. There's going to be some amount. Maybe it's $100,000. In some circumstances, maybe it's $1 million. It depends on the size coming your way. And this money we're going to set aside. You can do whatever you want.
Go have fun.
You go have fun. But for everything else, the other 99% or 90% or whatever the mathematics comes out to, we're going to put together a steady and consistent financial plan to work through the best way to utilize those dollars. So if you are a Mega Millions jackpot winner, I'll be happy to talk with you. I'd love for you to reach out. One of the fallacies that we see with wealth, especially windfall wealth, is people enter into it thinking, I've got more money than I can ever run out of. And we've seen it time out of time again. Someone will have a huge inheritance that should set them and their next generation up for life. And 10, 15 years in the future, it's squandered. Mm-hmm. Somebody sells a business they built their entire life building, and then 10 years from now, they're having to make concessions in their financial life because of the decisions they made. Money can run out, and it doesn't matter how big the number is, you can squander it. And you have to you should be just as scared with wealth as you were before you had wealth. It's a different kind of pressure, different kind of stress, but it's certainly something that you have to think about and approach tactically.
Yeah.
Tactfully. Thank you.
I got you. That was a good answer. Thanks so much for that question, Joseph. Let's move on.
Again, that website was aboundwealth.com.
It is true. They're just fantastic at helping with those more complex financial situations. Okay. Sarah has a question. She says, if saving 25% of her income towards retirement, so she's maxing out her Roth IRA, not maxing out 401k, she said, but what does the next step look like? She's got to that 25%. Mm-hmm. Should it be sinking funds? Should it be something else? What do you think?
So 25%, where we think that happens for most folks, is at step 7 of the financial order of operations. Again, if you're not familiar with this, go to moneyguide.com/resource. We have a free deliverable. If you want to know more about it and do a deep dive, we actually have an entire course, curriculum we put together. You can go to learn.moneyguide.com to dive into that. Step 7 is normally where people hit hyperaccumulation. It's where they get to that 25% savings mode, and they start thinking about their multiple buckets and that sort of thing. And so her question, I think you said Sarah, right?
Yes.
Is what happens next? What happens after that? This is where it's fun. Frankly, fun is what happens next, because you get to begin making decisions not based on what you have to do or what you should do, but what you want to do. A lot of folks reach out and say, hey, I'm saving 25% and I want to prepay my mortgage at 2.5%. And I grimace and I say, okay, great.
But if that's what you want to do.
If that's what you want to, if your goal is to be debt free, if your goal is to get rid of that debt, by all means, go forth with that, because saving 25% is what you should be doing if you want to have like a normal retirement on a normal retirement timeline. But perhaps you're saving 25%. You say, I still have more money. Great. Do you actually want to retire at the normal timeline, like 60, 65? Or maybe you want to retire at 55, at 50, maybe even in your 40s. There's some other things that you have to think about that go with that decision, but that additional funding, those additional excess savings capabilities, might need to bump that from a 25% savings rate to a 40% savings rate. You get to really start answering the why question once you're at 25%. From 0 to 25%, I think we're answering the what question. What do I do next? 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 At 25%, you get to start answering the why question. Why am I doing these things? Why do I want this? Why do I want to continue moving in this direction? And when the whys start replacing the whats, that's when your great, big, beautiful tomorrow shows up. That's when you get to start thinking about those things. So for some people, it's additional savings. For some people, it's prepaying low interest debt or prepaying future expenses or knocking out low interest debt. Maybe it's saving for college. Maybe it's helping children. Maybe it's helping grandchildren. Or maybe it's consumption. Maybe we have one client, and this guy, I love when I talk to him. He likes nice cars. Like his I don't want to say vice because vice has a negative connotation. He just loves nice cars, but he always is like he's like, hey guys, I'm nervous. And we're like, dude, do it. You can afford it. You're doing everything right, everything you're supposed to be doing. If you want to go buy a nice car, or if you're someone who wants to, maybe you're someone like Brian Preston. You want to be able to take your daughter to Paris, and you want to go do a big trip. And you want to, by all means, if you're checking all the other boxes, go do that. We only get one chance at this life, so we have to balance saving for the future, but also living presently in today and enjoying every moment.
Well said. So yeah, if you're hitting that 25% consistently, that is when like you kind of get to make some of these choices and have some discretionary actions next. So honestly, great job getting to the 25%. So thanks so much for that question too, Sarah. Okay. C has asked, it looks like a lot of people have echoed this. He says, I have $20,000 in I bonds that become withdrawable in December. What are your thoughts on using that money as an emergency fund once the funds become withdrawable?
Yeah,
How should you think about that?
So I want to set the record straight. It seems like back in the day, me and Brian were getting a lot of flack. Like we didn't like I bonds. We do not dislike I bonds. I think we share with you guys why. There's some things that go with it, right? So when you do I bonds, right now the rate's fantastic, super, super sexy, but it's not locked in forever. The thing about I bonds is that the rate adjusts, right? So right now, while we have this high inflation rate, I bonds have a really, really attractive yield, which is awesome. You got to hold it for 1 year, and you can't go like buy them at Fidelity or Vanguard. You actually have to go to the Treasury Direct website to do it, and you're limited. You can only buy $10,000 per individual each year. But some people do ask this question, like, hey, I've got $20,000 and they're about to expire. Can I consider that part of my emergency fund? I don't think that's a crazy thing to do. I like to have emergency dollars readily available to me, right? So when I think of an emergency, I think of a big deal, like I need money quickly. I need to be able to go grab it quickly. So if you're someone who has like a 6-month emergency fund, and that's what makes sense in your situation. Maybe you're a single income household, or you have higher living expenses, or there's debt service that has to be taken into account. Whatever the thing may be, yeah, it's probably not crazy for maybe some of those later months to be held in I bonds, but I'm a proponent for, if I have to get to money tomorrow, I want to be able to go move it and, like, if not same day, within 2 days, be able to recoup that, be able to bring that back. There's nothing wrong with, if you're someone who wants to do an I bond ladder and you want to, like, do the $10,000 every year and build that as a cash holding. I don't think that's crazy. There's just some logistics you have to jump through to be able to do that well. And I get that the rates right now are so attractive. It'll be interesting to see what they look like 5 years from now. I can remember, now look, it's not 9%, but I can remember money markets as recent as 2019, we're paying like 2.5%, almost 3% just on high yield savings accounts that you can access same day.
That sounds nice.
It sounds really nice. And we're starting to see it creep back up. We're starting to see rates come back up. I do think likely we'll get back to more normalized cash giving us a decent, again, it's not 9%. I don't want to, don't think I'm bad at math. I get that 9% is better than 2.5%. But in terms of what your emergency fund is and what it's for and the amount of time, effort, and attention you want to put into that versus the other facets and areas of your financial life where you could put time, effort, and attention, I would just kind of weigh the pros and cons with that. But to answer C's question, I don't think there's anything wrong with it. We're not anti-I bonds. We're not anti-I bond ladders. We're not anti going out and getting great yields, but it has to make sense for your situation. You have to make sure that you're not, by doing that, by implementing that strategy, you're actually, cutting something else off that you should not be cutting off.
Yeah. Good answer. I hope that kind of sheds some light on that conversation and gives you some food for thought. Okay. Jolene has a question. She says,
Love your song.
What's that?
Nothing. Keep going.
You were going to sing the song.
I did. I was going to do it.
I was going to not do that because Jolene probably gets that all the time.
I know. Sorry.
Fantastic song, though. Not a bad association.
Interesting little tidbit. One of mine and Brian's favorite songs. If we listed out all of our favorite songs, be in the top-ish of both of our lists.
Really?
Yep.
I would never have known that. I'm glad to know it.
Glad to tell you.
So, anyway, Jolene's question. She says, what is your hot take on long-term care insurance? Is it worth the premium, or are you better off to self-insure?
Okay, long-term care insurance. So first, I'm assuming you know what long-term care.
I do.
Long-term care insurance is insurance you get that will pay for you later in life if you have to go into if you need nursing care, skilled home nurse, something where you need someone to help you be able to live the daily functions of your life. I'm probably oversimplifying that explanation, but that's basically what long-term care insurance is. Well, as we're all living longer and as we're seeing more I'm going to call it cognitive decline, diseases that are becoming more prevalent, and we're having experience with loved ones entering into those kind of things, a lot of people are thinking about long-term care insurance. Man, I'm really nervous about if I need to go into skilled. I don't want to be a burden to my family. I don't want to spend down all of our wealth. So should we do long-term care insurance? Well, here's the problem with it. It's pretty expensive, and it's getting more expensive. Back in the day, rewind 20 years ago, I don't think insurance companies really knew how to price these things. They were putting together long-term insurance policies with really great benefits at really low costs. Well, we've seen the cost of healthcare increase and people living longer. And so now these policies are oh boy, insurance companies say we have a problem. And so it's not uncommon. We've seen a lot of our clients who had policies from 10, 15, 20 years ago now start to see increases in their premiums. So now it's becoming very, very cumbersome. We here are fee-only financial advisors. We don't sell any insurance. We just consult on it. But we do have some clients that are in the insurance brokerage world. That's what they do for a living. They say long-term care insurance is one of the hardest insurances to sell because everybody wants it. Everybody likes the idea and the theory of it. But when it comes to brass tacks, actually writing that premium check is not something that a lot of people want to do. In our opinion, there's sort of a donut hole that exists where we think long-term care insurance makes a lot of sense. If you're someone who has a total net worth, or what I'm going to say is consumable net worth of less than $1 million. Now, this isn't a hard and fast number. This is just our flavor of a number. It's really expensive, and it's kind of burdensome to be able to go out and pay that premium depending on what your other sources of income are. Now, if you have pensions and Social Security and that kind of thing, and your standard of living is covered by that. But if you have less than $1 million and you're living off of those assets, long-term care insurance can be a very sizable number that you're paying for. So in most circumstances that we've seen, it's just too expensive to justify. Well, then on the other end of the coin, if you're over $3 million, $4 million of total net worth, there's a really good chance that even if you were to receive skilled nursing or you were to go into a nursing home, there's a good chance that you have enough assets to where you can self-insure. It's really those folks that are in that 1 million to 3 to 4 million range where we see most people most likely to end up purchasing a long-term care insurance policy. And so then you have to answer some questions. All right, if I look at my genealogy, if I look at my parents, my aunts, my uncles, my grandparents, what takes them out at the end? Is it a massive cardiac event, or is it dementia, early Alzheimer, is it the types of diseases that require this, or genealogically, is it something else? And you kind of weigh the likelihood and probability of you needing that, and then you have to just run the quote And people always ask, well, how much do I quote? Here's what I would do. Man, I don't mean to be going long on this question.
No, it's a good details to have.
Here's what I would do. In your area, the area we live, I'd call the nicest nursing home facility that you think you'd want to live in, right? So they're not all created equal. Some have nursing, some is just like basic apartment living for people that are more advanced in age. Figure out kind of what it looks like. And I'd ask them, hey, how much does this cost? Is it $3,000 a month? Is it $8,000 a month? Is it $1,500? Figure out what that number is. And then say, okay, if I had to foot the bill for this, it'd be great if I had, $3,000 benefit coming in and I could cover whatever the difference is. And I'd go get a quote on that. That's how you figure out what your quote is. And then if you're in that donut hole where long-term care insurance might make sense, I would consider, can I justify the cost versus the perceived benefit that I would get? Now, all that to say, I understand it is changing, right? There are new policies coming out. Again, we have a lot of friends in the insurance world. Now there are even like single premium where you can just take a chunk of money and drop it in today and it'll provide a long-term care benefit. As with most things, you got to get a quote, see the cost, project it out, and determine what makes sense. If you're asking for my hot take on long-term care, I think most people don't buy it. That's my hot take. Most people, we work through the exercise, we do the analysis, we determine the exposure, and when it comes down to brass tacks, we say, okay, here's everything. We've laid out all the scenarios. What do you want to do? They say, okay, I don't think I want to proceed. And that's the way a lot of our conversations end up going. But you got to do the work before you can get there.
Right. And is it because, they already have a financial plan that's kind of helped them hit financial independence a lot of the time?
Right. A lot of people say, oh, I'm going to make up a number. I need $8,000 a month to live off of in retirement. Okay, well, great. We have proven that your financial assets can survive all the way out until age 95, providing you with a standard of living equal to $8,000. We have a high probability of success. Well, even if you had to go into like nursing home, skilled nursing care, your life expenses are probably going to drop because you're not doing all the things that you were, and you're going to replace that expense with the cost of that facility.
Right. It still might be enough to cover.
That's right.
Depending on where you're at.
That's exactly right.
Yeah.
For the majority of cases that we run through, that's what we see.
No, that was a really good answer. Good information. Thanks for your question, Jolene. We appreciate it. Okay. Anthony has a question. He says he's 51 and he's thinking about not just saving for the future anymore. He says, should I use some of my life savings to pay for grandkids' college? Should he be putting that away for them? Is that something that he should think about? Just in general, first of all, but secondly, because college is becoming extremely expensive. So A, they might need the help, but B, will it be worth it? Is that going to be the path that they take? So how should he think about that decision?
It's interesting, Anthony. I am a parent. I've not yet had the pleasure of being a grandparent. From what I understand, it's a lot more fun. We just got back.
That's what I hear.
We just got back from the beach, me and my siblings and my parents. It was great. We have a bunch of little kids, little cousins running around, and my grandparents were like on cloud 9. And I think they were on cloud 9 because they got a week of just this insane craziness. And then all of us parents took the kids back home.
Bye.
So it's wonderful. Yeah. I know how much I love and dote on my kids. I can only imagine that is like multiplied times a million when it comes to grandkids. And so naturally, our bent is, how can I help this person? How can I provide an opportunity for my grandchild so they can do whatever in the world they want? That's like a natural thing that exists. Well, the answer to whether you should do that really depends on your financial situation, your financial circumstance. How shored up are you? How well is your plan put in place? Because Anthony, at 51, I'm going to assume you're still working. Let's say that you're going to want to retire at 65. Your number one priority needs to make sure that you can provide for yourself for the rest of your life. It's counterintuitive, but that should be priority number one. It's no different than when we get on an airplane, what do they always tell you, right?
Put your oxygen mask on first and then the other person.
That's exactly right.
Same thing.
Again, I've been blessed. I've never been in a situation where I've had to do that and like put mine on before my kids. But I like to think that I would. It's been like drilled into me. Your financial life is the exact same way. One of the best gifts that you can give to your children or to your grandchildren is not being a burden on them later in life because you ran out of money, because you didn't plan well. Now, it's not uncommon, Anthony, maybe you're in a very solid financial situation, and if you were a client of ours, what I would do is say, okay, hey, let's run this through a simulator. Say, okay, well, how much are you going to save? How much are we going to start putting aside for college? Are we going to save that just like in a brokerage account where it's still there to access? Or are we going to like commit to 529 assets and determine what kind of impact does that have on your financial life? If you can afford to do it without sacrificing your financial viability, then yeah, maybe that's okay. If doing so would actually be a detriment to your financial health and well-being, I think you have to avoid doing that. Now, here's an aside. Saving for college for grandkids is great. A lot of times we see parents and grandparents who really love to provide a safety net or like a supplemental income to their kids and their children. It's so great. You know, we love the book, The Millionaire Next Door, written by Dr. Thomas Stanley and Dr. Stanley and Dr. Danko. And one of the things they talk about are like these 7 traits of millionaires. Well, one of the traits of millionaires is that they have adult children that are self-sufficient, that are not receiving economic outpatient care. And the other thing that's really interesting is they themselves never received economic outpatient care from their parents. So college is a little bit different, but if you can raise children and grandchildren that can stand on their own feet, that can make their own financial decisions, that can provide their own path, you're probably doing a lot more for them than shelling out dollars and supplementing their lifestyle and creating something that's going to be very hard for them to keep up if you cannot keep that up.
Yeah, really good answer. Thanks so much for your question, Anthony. Okay, this next one's a fun question, and this username, here we go. This is from OMG Mr. Pickles. Love it. He says, "Hey team, always love the content." Thank you. Glad to hear it. I was wondering if you have any resources for combining finances pre and post marriage. He recently proposed successfully. Congratulations. And he's trying to plan ahead for the next step. So we do have a lot of resources for him.
Okay, I thought this question was so different. Okay, I'm with you now.
What did you think?
His question was, hey, I'm thinking about combining finances. What tips do you have pre and post marriage? I think he was thinking like, all right, well, how do we prepare for this? And then when this whole thing doesn't work out, what's the out strategy?
No, he means like in the engagement phase and then in the married phase.
Got it.
Very different. Very, very different.
That's awesome. Okay.
That's funny.
All right. So he wants to know like what advice do we have pre and post? Ruby, you have been married.
I have.
Much more recently than I have been married. What would you say to him? Like, what are some things that you would sell him, or what are some things that you did personally that helped you guys prepare for marriage, but then also kind of combine and put things together, if you guys even put things together?
Yeah, no, first of all, definitely have the conversations. I love this question because you are setting yourself up for success just by having this conversation with your fiance and then continuing that when you're married. The second thing is, I think you do kind of want to talk about your why. Like, okay, what are we after? Are we trying to pay off debt? Are we trying to reach financial independence at a certain time? How do you see yourself living when we're 65, you know, or even how do you see yourself living when we're 30, 40, 50, those kinds of things. Just having those conversations ongoing is the right call. And then that's when you can kind of get a plan in place, right? And that's why we have the financial order of operations. We talk about this all the time, but it's truly perfect for this kind of thing. When you're in a relationship, it's 9 steps. These are tried and true. It's going to tell you exactly what to do with your next dollar together. And so it's going to give you something to focus on together, to unite your goals, so that when you are kind of like, all right, this is our budget, or we need to save this, or we want to invest here, you both know why. And you know, like, well, we have to get that employer match first. That's step 2. It's going to help you have those conversations and kind of take the guesswork out of it, and even take a little bit of the opinion out of it. Like, oh, well, I want to do this. Well, I want to do this. It's going to give you something to unite on. So those are definitely the kind of conversations that my husband and I have had. And we've definitely kind of come back to those 9 steps a lot throughout our life, even as like, you know, we just had a kid or we bought a house a few years back, that kind of thing. It's also going to bring you back. I'm a big proponent for that. Like, okay, we just put this down payment on our house. We paid for movers, all this crazy stuff. Okay, wait, now where are we? Okay, we need to go back to like step 5, make sure that emergency fund is good, all of that. So I highly recommend that. You can download that lovely handout that Bo just held up, the 9 steps, for free. learnmoneyguy.com/resources. That's available to you. But honestly, for you, the deep dive might be even more perfect. We have a course that you can work through with your fiance at learn.moneyguy.com. It's got tons of videos of Brian and Bo doing a deep dive on all the steps. We've got a homework handout for you to work through together. It's going to help you, actually see how it's customize those steps to your situation. And then also we've got a community, a Facebook group out there with all the other course participants that you can, swap stories, share notes, kind of get advice, help each other out, and just connect with other like-minded people who are going through this as well. And some people who might be in similar circumstances to you guys. So that's what I would say. That's been super valuable. And then kind of as a side, I know this is kind of maybe it's a hot take. I don't know. You have to do what's right for you, but we did combine bank
Everything
accounts.
joint. Love it.
And I think it's really helpful. It definitely helps. It's never a competition. Nobody's ever guessing what the other one is spending, or it just makes communication so much easier. So I am a proponent for that, just based on my experience. So I would definitely talk about that and consider doing that, just because I think it's going to set you up for success in the long run and actually unite your financial plan, your financial decisions. So yeah, that's what we've done, and it's been good so far. We're still on the journey with you, but those are great places to start.
I love everything that you said. I'll speak to one thing that you didn't say that I found in my marriage was super, super valuable. We also combined joint accounts. Now, I don't want to suggest that you have to do that.
Yeah, some people don't.
We have clients that keep separate accounts and do separate things, and they have a highly efficient and effective functioning financial household. For us, everything together made a lot of sense. Joint accounts, joint credit cards, all the stuff. What it allowed me to do is my wife and I have different consumption behavior. She's not a crazy spender, but she's crazier than I am, right? She spends more money than I am. And we place value on different things.
Sure.
Well, when we first got married, it was hard for me to get my mind wrapped around that. I'm like, babe, why on earth are you spending that much on shampoo? Suave is $1. You can go get... Why are you buying the organic? Why are you buying that type of food? We can go do. Why are you? What it forced us to do, because everything was together and we had the same credit card statement and we had the same bank account, is we saw, when I went to the grocery store, she saw the way I did it. And when she went to the grocery store, I saw the way that she did it. And we were at the grocery store and, send each other, we go get different things and we look at the buggy. It's interesting, right? It allowed us to figure out what each one of us values. Frankly, I had to learn a lot more than she did. She warmed up to saving way faster than I warmed up to spending, but she's a much better person than I am. I'll make no bones about that. She is a wonderful person.
Jenna.
We had to really recognize what is different about us. And just because she values this doesn't mean that I should not, or try to change her mind from valuing that. But what we did to get us on the same page, and you said it right, is we had some common goals. Hey, we know we want to start a family. We want to do this. We want to be able to do this. We want our life to look like this in 10 years. We want our life to look like this in 20 years. And we had those common visions where we say, okay, hey, if those are the things that we value and those are the directions that we want to be heading, here are the steps that we should take to get there. Now, in my mind, I'd have us saving 70% of our money because I love saving. That would not work for her. So we had to find out some balance that, okay, it's okay if we save money this way, but it's also okay if we spend money this way. And me, being the financial person, it took me a long time to recognize that I can't just beat her over the head with how we ought to do finances. It has to be this mutual thing that we figure out together and we work on together and we talk about together. And that's allowed it to be, it's just not a source of contention anymore because we practiced and practiced and practiced and practiced and practiced. So I think the earlier you can figure that out in marriage and not let money be in it. I don't know the stat. We used to have the stat about how many divorces are cited. There's infidelity, but I think that the second or one of those.
It's a high reason, finances. Arguments about finances. That's right. Yeah. You don't want that to come in your way.
If you can solve, or not solve, but start working on that early on in your marriage, I think you're going to give yourself a higher likelihood of setting yourself up for success. But here's the other thing. It's hard for people that are young starting out to do this. It's also really hard for folks that are later in life. Perhaps this is a second marriage, or perhaps that you've built up your own financial thing, you have your own financial baggage that you're bringing into it. I think for every relationship you go into like that, the earlier you can get on the same page about what you value, how you want to treat finances, if you guys can find an agreement on that, it's just going to set things up to be a lot. Marriage is hard. It's hard. The more things you can move out of the hard category, the better off I think
it makes it easier. For
That's
sure.
Right.
And so, congrats on your engagement. Hopefully that kind of gives you some good food for thought and some action items. Thanks so much for asking the question. It's a great question. Okay, we got a question from Siren Eye. He says, is the 3-bucket strategy even across all 3 buckets? Is that what you should be going for?
All right.
And should he strive for that?
Love it. But do you want me to talk about what, because I feel like if someone's listening to us for the first time, you've never heard us talk about it. 3-bucket strategy. I thought this was a finance show. Why are they talking about buckets? What
it's
is
the
that?
3 tax buckets, right? And I will let you go into detail because you're way better at it than me.
Okay.
But
So we say that when it comes to accumulation, when your portfolio reaches a certain mass, you want to have 3 buckets when you get to financial independence. You want to have your pre-tax bucket. These are the things where you put money in, you got a tax deduction, but when you pull it out in retirement, you got to pay tax on it. So it's like traditional IRAs, pre-tax 401ks, IRA rollovers, those types of accounts. Well, then there's this other bucket that's a tax-free bucket. You put money in, you didn't get a tax deduction on the front end, unless it's an HSA. The money grew tax deferred, and if you pull it out with for qualified expenses at the right time, it can be completely tax-free. That's your other bucket. Well, there's this third bucket that kind of sits in the middle. It's the after-tax bucket. So it doesn't have tax-incentivized growth, but every year you pay taxes on it, but often it's at more favorable capital gains rates where it's not at the same ordinary income rate. So when you get to retirement, if you can have these 3 buckets well-established, you get to control what you pay in taxes in retirement. Don't we all want to have control over our tax situation? We have a lot of clients who are 7-figure net worth clients who have 6-figure incomes in retirement, and we're able to keep them in the lower tax brackets because we can pull some out of their pre-tax accounts, and then we pull some out of their taxable accounts, and you can pick and choose when you pull money and what kind of money you pull out of it. So Siren Eye's question is, should they all be equal?
Yeah.
Should my goal be a third, a third, a third? I think that'd be nice, but it depends on what your goals are, right? If you're going to retire at 65, a third sounds great. But I'll go ahead and tell you, Charles in the chat right now is going to tell you, if you had all that money in Roth, you'd be much better. Because when you get to 72, you're not going to have required minimum distributions. You'd rather have that. Or if you're someone who's going to retire early, and maybe you want to leave the workforce at 45 or 50, you might not want a third. You might want to have more in that after-tax bucket so that you have a bridge to get you to age 59 and a half. In reality, our circumstance determines how our buckets should ideally be set up. But what happens for most of us is the way we're able to build assets naturally dictates it. If we're following the financial order of operations, the very first thing we're going to do is we're going to go get an employer match. Step number 2, that's always pre-tax. Your employer has to put money into the tax deferred bucket of your retirement plan. They can't do Roth for it. So even if you're doing Roth and you're getting a match, that match is going pre-tax. So most of us, unless we're converting, we're going to have some level of pre-tax assets. We're going to have some level of pre-tax assets built up in that bucket. Well, then we start doing the tax-free thing. I want to put money in a Roth. Okay, great, $6,000. I want to go put money in HSA. Great. If I'm a family, I think it's like $7,300. Single, it's like half of that. But then you're capped. You can't put any more in that. So, okay, now I go back to my 401k. Well, do I do the Roth bucket or do I do the pre-tax bucket? Maybe I'm a higher income and I'm maxing that out at $20,500. Okay, I'm done. Maybe I still need to save more, so then I start saving in the after-tax. Or maybe I am an executive and a lot of my compensation comes in the form of grants or RSUs or stock options. All of those are going to build your after-tax bucket. So I think it's fine to have this goal of the 3 tax buckets, but in reality, the way that your income comes in and the way you go about saving is going to dictate which one gets filled up first. And the financial order of operations will not lead you astray. Now, I do think this is something that's interesting because I've not seen this before. Maybe it's out there. One of the things that we've done on our net worth template, on the dashboard, we actually show your tax buckets. Every single year, you can see where are my tax buckets? How much do I have in pre-tax? How much do I have in tax-free? How much do I have in after-tax? Well, while you're early on building, you just want to be building, following the FOO, following the FOO, following the FOO, following the FOO. As you begin seeing the landing strip for financial independence, as you begin approaching the runway, you can start thinking, okay, man, I need to be tweaking my buckets a little bit. I don't have enough in after-tax for early retirement. I should shift there. Or maybe I'm going to be hit with RMDs. I need to be focusing on Roth. Or maybe I need to have a strategy for converting from the time I retire until financial independence. If you're tracking your net worth statement every year using our template, you'll be able to naturally see that. You can't avoid it. It's right front and center on the dashboard. I think that, Sire and I, is where you're going to figure out, okay, and we have clients that are retired and all they have is after-tax money. All they have. And they're perfectly fine being retired. We have other clients that all they have is pre-tax money, a big 401k or big retirement accounts. They're okay. Ideally, you should have the 3 buckets, and how much you should have in the 3 buckets is determined by what you want your financial independence to look like and when that's going to take place.
Yeah, fantastic answer. Thanks so much for asking all of your questions, guys. If you still have questions, we've got a lot of resources for you. Just go to moneyguy.com/resources. Lots of topics, free downloads, free information for you. And then if you want a deeper dive and some more community around your financial conversation, you can join our course at learn.moneyguy.com. Great deep dive on the financial order of operations there.
If I want to throw this out there, if you're not following us on we're social now. We're doing, I just feel like we're social now. Like, it's legit. If you haven't gone to check us out on Instagram, on TikTok, on Facebook, on Twitter, that's another one.
Brian
Make sure
likes
you
to
go.
use Twitter.
I might actually be talking directly to Brian on Twitter if you go hang out with him there. We love interacting with you guys. We love that we even get to do this show. I mean, we put together the content we come up with as a team, but when we can actually answer your questions and interact with you directly, that's the reason we're here. That's the charge for why we do what we do. So thank you so much for letting us be a part of your financial journey. If you guys keep showing up, we will keep loading you up. Let us know what you want to hear from us. Thank you all so much for hanging out. Brian, we hope if you're watching in Paris, we hope that you enjoyed this show. We hope all of you enjoyed this show, and we'll be back with you in no time. I am today's host, Mr. Bo Hansen, here with producer Reby. Money Guy team, out.